Can the government prevent the next financial crash? It's a question everyone's asking, from Wall Street to Main Street. And the real answer is brutally simple. They can delay it, they can manipulate it, and they can try to hide it, but they absolutely cannot stop it. Financial crashes are not random acts of God or unpredictable black swan events. They are mathematical certainties. They are the inevitable consequences of economic cycles, flawed policy decisions, and systemic imbalances that are deliberately built into the system over years, even decades. Now, governments and central banks around the world work very hard to convince you, the public, that they have everything under control. They project an image of stability and command. But the truth is, every single major financial collapse in modern history tells a completely different story. Think about it. The Panic of 1837, the Bankers' Panic of 1907, the Great Crash of 1929, the Oil Shock of 1973, the Great Financial Crisis of 2008, and the pandemic shock of 2020. What do they all have in common? Every single one of them was preceded by a series of government and central bank interventions that were specifically designed to avoid a crisis. But in the end, those very interventions only made the inevitable collapse bigger, faster, and far more painful. Take a look at their playbook. What do? They roll out massive stimulus packages, they manipulate interest rates to artificially low levels, they print unprecedented amounts of money out of thin air, and they constantly tweak regulations. On the surface, these actions create a temporary illusion of stability. The stock market might rally, unemployment might drop for a bit, but underneath, they are accelerating long-term instability. They're not solving the problem. They're just kicking a much larger can down the road. The 2008 crisis is a perfect example. It wasn't prevented by the system. It was simply postponed by a series of emergency bailouts and zero interest rate policies that had never been tried before on that scale. Then came 2020. The global economy was put on life support with trillions and trillions of dollars in liquidity injections. And what was the result? The worst wave of inflation we've seen in over 40 years, eating away at your savings and your purchasing power every single day. Here's where it gets truly concerning. Today, the situation is far more precarious than it was before 2008 or 2020. Global debt levels are astronomically higher. Asset bubbles in stocks, real estate, and other areas are far larger and more fragile. And most importantly, the tools that governments and central banks used to fight the last crises are now severely limited or even exhausted. Stay with me till the end of this video because what I'm about to reveal isn't just speculation or some wild theory. It's based on historical patterns and hard data that the people in charge really don't want you to notice. They prefer you stay calm and don't ask the tough questions. So if you're new here, do me a favor and subscribe right now and make sure you hit that bell icon so you don't miss what's coming next. And before we go any further, I want to know what you think. Drop a comment below right now. Do you believe governments can truly stop a financial collapse, or are they just buying time? I'm genuinely curious to read your answers before we get to the conclusion, because by the end of this video, you'll understand precisely why even the most powerful policymakers in the world are terrified of what's coming next. Governments operate under what I call the illusion of control. They make grand pronouncements and release complex policy papers, but markets in the long run are not driven by political promises. They're driven by cold, hard fundamentals, things like productivity, corporate profit cycles, real human behavior, fear and greed, and most critically, the sustainability of debt. When those fundamentals turn sour, no amount of political spin can hold back the tide forever. When a crisis starts to emerge, the official response is almost always the same. It follows a predictable knee-jerk pattern. First, they slash interest rates to make borrowing cheaper. Second, they inject massive amounts of liquidity, money printing, into the financial system. Third, they provide bailouts to too-big-to-fail institutions. And finally, after the dust settles, they implement a new wave of regulations promising that this will never happen again. But here's the disruptive, inconvenient truth. Those very actions are what sow the seeds for the next, even bigger crash. Lowering rates for too long encourages reckless borrowing and speculation. Printing money devalues the currency and creates asset bubbles. Bailouts create what's known as moral hazard. They teach institutions that they can take huge risks, and if they fail, the taxpayer will be there to foot the bill. It's a vicious cycle, and we've been trapped in it for decades. Right now, central banks are backed into a policy corner. It's a trap of their own making. If they raise interest rates aggressively to fight the inflation they created, they risk triggering a catastrophic debt crisis and a severe recession. But if they cut rates to try and stimulate the economy, they will just pour gasoline on the fire of inflation and fuel even more dangerous asset bubbles. They are stuck between a rock and a hard place, with no easy way out. And the scale of the debt is simply mind-boggling. The United States government alone is now over $34 trillion in debt. But that's just one piece of the puzzle. Global debt, that's government, corporate, and household debt combined, has surpassed $300 trillion. At these unprecedented levels, any policy move becomes incredibly dangerous. The system has become so fragile that the balancing act is no longer between growth and recession. It's between a deflationary collapse and a hyperinflationary currency debasement. On top of this, we have other massive forces at play that amplify risk. Extreme wealth concentration means a tiny fraction of the population owns a vast majority of the assets, making the system more top-heavy and unstable. We have a speculative culture fueled by social media and get-rich-quick narratives that drives bubbles in everything from meme stocks to cryptocurrencies. And then there's the rise of AI-powered high-frequency trading, where algorithms can cause flash crashes and amplify volatility faster than any human regulator can even comprehend, let alone intervene. So here is the chilling but honest truth. The next crash won't be prevented. It can't be. Instead, it will be redirected. What does that mean? It means governments will not be able to stop the financial losses, so they will shift the burden onto you, the general public. They'll do this through the hidden tax of inflation, which silently steals the value of your savings. They'll do it through higher direct taxes on income, property, and investments. And in the most extreme scenarios, they might resort to currency manipulation, capital controls, or other desperate measures that make the public absorb the shock of the system's failure. This video is not about spreading fear. I want to be very clear about that. It's about providing clarity. It's about pulling back the curtain and showing you how the machine really works, not how they tell you it works. And the clearest conclusion from all the evidence is this: government policy can influence the timing of a crisis, but it cannot change its ultimate destiny. The math is the math. Now stay with me for these final minutes, because this is the most important part. I'm going to reveal where the data suggests the next chain reaction is most likely to begin, and what the smartest, most experienced market participants are quietly preparing for right now while everyone else is distracted. The most likely trigger for the next crisis is the sovereign debt market, specifically in a major developed economy. For years, government bonds were considered the safest asset in the world. But with debt to GDP ratios at record highs and with inflation proving sticky, that assumption is being seriously questioned. If a major country, like Japan, a large European nation, or even the United States, were to see a buyer's strike in its bond market, where investors suddenly demand much higher interest rates to lend the government money, the entire global financial system would seize up overnight. The interest payments on the national debt would skyrocket, forcing brutal cuts to public services and massive tax hikes, triggering a deep recession. This is the scenario that keeps central bankers awake at night. So what are the smartest investors doing? They're not panicking. They're preparing. First, they are reducing their exposure to overvalued assets that depend on cheap debt, like speculative tech stocks and over-leveraged real estate. Second, they are increasing their holdings of real, tangible assets, things that have intrinsic value and can't be printed into oblivion. This includes physical gold and silver, which have served as a store of value for thousands of years. It also includes productive assets like high-quality farmland and strategic commodities like energy and copper, which will be essential no matter what the economy does. Third, they are holding a significant portion of their wealth in cash and short-term treasuries, not as a long-term investment, but as dry powder. This gives them the liquidity and flexibility to buy incredible assets at bargain basement prices when the next crisis inevitably hits and everyone else is forced to sell. Remember, fortune favors the prepared. Crises are not just times of risk. They are also the moments of greatest opportunity. The system, as we know it, is running on fumes. The illusion of control is fading, and the mathematical reality is coming into focus. Your job is not to be scared, but to be aware, to be educated, and to be prepared. Start questioning the official narrative, do your own research, and take prudent steps to protect yourself and your family. Don't wait for the government to save you. They will be too busy trying to save themselves. Have you ever wondered why, after every financial crisis, we're told it will never happen again, yet it always does? The reason is simple. The next crash is already built into the system. It's not a question of if, but when. And historically, the when is always the moment public confidence shatters. Let's break it down. Every major financial crisis starts the same way. The markets, feeling safe and secure thanks to government policies, ignore massive growing risks. In 1929, it was rampant speculation fueled by easy credit. In 2008, it was a housing market propped up by risky loans and complex derivatives that nobody understood. In 2020, it was a global shutdown met with unprecedented money printing, which artificially pumped up asset prices to absurd levels. Now, look at where we are today. We're facing a dangerous cocktail of all three: sky-high debt, assets valued far beyond their real worth, and a financial system driven by AI and algorithms that can trigger a market-wide sell-off in the blink of an eye. The speed of the next crisis will be unlike anything we've ever seen before. So, what will governments do when it happens? They'll pull out the same old playbook, slash interest rates, inject emergency cash into banks, and use your taxpayer money for bailouts. They might even introduce new tools, like directly depositing digital currency into people's accounts. But here's the crucial thing to understand. These are not solutions. They're just temporary fixes that treat the symptoms, not the disease. Governments don't prevent crashes. They just move them around. They either push the problem onto future generations by piling on more debt, devalue your savings through inflation, or weaken the currency itself. Think of it like a leaky pipe. Instead of fixing the leak, they just keep putting bigger and bigger buckets underneath it. Sooner or later, the buckets will overflow. You won't hear this on the mainstream news because the entire financial system runs on one thing: confidence. The moment the public loses faith, no amount of reassuring speeches from central bankers can put the pieces back together. The truth is, kept quiet to keep the game going. If you look back at every crisis intervention since the 1970s, you'll see a clear repeating pattern. The government prints money to stimulate the economy, which creates a bubble in assets like stocks or real estate. Eventually, that bubble pops. In response, the government prints even more money to stabilize the situation, which then seeds the next, even larger bubble. It's a cycle of boom and bust, and each cycle gets more extreme. Right now, we're in a very tricky spot. Central banks are trying to fight the inflation that their own past policies created. They've raised interest rates just enough to slow down the economy, but not enough to actually stop inflation without causing a massive debt crisis. And with governments themselves drowning in debt, they can't afford to keep interest rates high for very long. This means their next move is predictable. They will likely be forced to cut interest rates again, even while inflation is still a problem. This is exactly what they did in 2001 and 2019, and it will pour gasoline on the fire, setting the stage for an even bigger crisis. This isn't just another dip in the market. It's a fundamental, structural problem that has been building for decades. The warning signs are already flashing. Banks are showing signs of strain, heavily exposed to a shaky commercial real estate market and unprepared for interest rate swings. And then there's the shadow banking system, a massive, unregulated world of private credit and complex derivatives that regulators can't even see, let alone control. It's a ticking time bomb. What makes this time different is the technology. AI trading models are programmed to sell based on volatility, not on the health of the economy. When the correction begins, these automated systems will accelerate the crash faster and more violently than any human-driven panic in history. By the time governments and central banks react, it will be too late. They will be playing catch-up, managing the aftermath, not preventing the disaster. Here's the uncomfortable truth. Governments aren't preparing to stop the collapse. They are preparing to control the narrative and manage the public response. Expect them to blame anyone but themselves. Expect a push for digital currencies, not for convenience, but for control over your money. Their policies won't be designed to fix the system, but to centralize their own power and authority. Financial crashes aren't policy failures. They are inevitable resets of systems that have become unsustainable. And the next reset is going to transfer wealth on a scale we haven't seen since the Great Depression. Those who understand this cycle won't be panicking. They'll be positioning themselves for the shift. Those who are waiting for an all clear from the authorities will be the ones left behind. If you've watched this far, you know this information is critical. Make sure you subscribe, because in my next videos I'm going to break down exactly which industries are most vulnerable, which sectors could actually benefit from this chaos, and what key signals you need to watch so you're not caught by surprise. Now I want to hear from you. Drop a comment below. Do you think governments can actually manage the fallout, or will they just use this crisis to reset the system under their control? I'll be reading and replying to the most insightful comments. Stay alert and stay informed, because what looks like stability today is just the quiet before the storm. Thanks for watching.